Welcome to the third video of our Numbers Games series where I teach you how to analyze and backtest your trading strategies on past stock data. Today's focus is volatility contraction pattern. We will define it and together look for it in historical stock data. The volatility contraction pattern consists of a price contraction of a stock's trading range, usually after a period of price increase. You can clearly see that range during this period is much bigger than range during more recent period. So technically, this can be considered as volatility contraction pattern. Typically, it's worth combining it with a series of higher lows, as you can also clearly see on this chart. So why should pattern be of your interest? Volatility contraction pattern serves as an effective tool to identify promising technical entries with clear risk parameters. Furthermore, it can potentially signal an increase in stock's interest as buyers tend to observe every price decline, leading to a pattern of higher lows. This pattern has to a large extent been popularized by Mark Minervini. He has used it to find good entries and as an instrument to measure institutional interest in stock, which often precedes a substantial movement in its price. However, I'd like to note that the volatility contraction pattern itself is not a buy signal. Its nature can result in really violent moves in both directions, and thus you really have to use solid risk management practices alongside with it. Furthermore, volatility contraction pattern shouldn't be used in isolation. It performs best when combined with other indicators, such as technical breakout or robust fundamentals of underlying company. If volatility contraction pattern trade appears to be overcrowded, it might make sense to fade it, as traders are likely to exit swiftly in case breakout fails, and big drops in price are then fairly common. And if you haven't read Mark Minervini's books, I can definitely recommend them. His books have provided me with a much deeper understanding of this pattern, as well as appreciation for the necessity to have good risk management practices. But before we continue with creation of filter for our data, let's check a few examples of volatility contraction pattern. In my opinion, it's always critical to understand what exactly we will be looking for in the data before jumping to the code. So what are the key characteristics of this pattern that we will be looking for in the data? First and foremost, a decrease in stock's volatility. Second, a series of higher lows. Let's now look at a few examples, and naturally, we'll start with Mark Minervini's past trade. So here's the first example where entry has happened on this date. Base is relatively short, but you can clearly see that the volatility has dropped, and Mark has entered the stock after a very narrow trading range. Also, the stock has demonstrated a series of higher lows. Here's another example, although maybe not as nice looking. We can see that in more recent time there was a certain decrease in the range, and Mark has entered on a breakout day. Yes, stock though was not in a very strong uptrend as visible on the chart. We'll continue with other examples, although we'll be a little bit quicker. Here's another example of the actual trade. Mark has entered on this day, and if we consider a longer base, yeah, we can see that a recent trading range was a little bit smaller compared to older data. A few other examples that I was able to locate in the data. Very nice looking flag or volatility contraction pattern, but yeah, as we can see that it didn't work that well after a very narrow day. A few other examples. All right, great. So how do you practically implement the volatility contraction pattern? My approach to code design always begins with identifying clear examples, which we've already done, and then defining what I will be seeking in the data. In this case, the primary characteristics are decrease in volatility, a series of higher lows, and let's also introduce a condition on the uptrend. All right, so we'll shortly continue with the code, but please ensure that you watch my previous video to learn how to install R and download past stock data. For now, I will be assuming that you have historical data on hand. All right, great. Now we can continue to the most exciting part, where we would actually start looking for volatility contraction pattern in past stock data. You will have to first load these two libraries, and then I assume that you have been able to download past historical data and store it into the following data frame. Unless you've already done so, please watch my previous video on how to efficiently download past stock data in a few simple steps. Our stock data is on daily basis, and we'll be passing it through a series of functions using a pipe operator, starting from ordering data by ticker and date. This ensures that all computations are done correctly. Then we're grouping our data by stock, which effectively ensures that all subsequent computations are done separately for each stock and data doesn't overlap across different tickers. Mutate function is used to create a series of new columns. I will not be covering it in depth since similar computations have been explained in my first video. But to give you a perspective, from min function is really critical. We use it, for instance, to compute the average trading volume across the last 10 days, or moving average of difference between high and low prices for last 2 days, 10 days, and 20 days, which is effectively a measure of trading range. Let's run it to create an updated daily price data frame with new columns. And now we can finally start applying filters to our data in order to identify historical instances of volatility contraction pattern. Let's start with the most critical condition. So the first condition allows us to narrow our trading range. This condition is optional, and it effectively allows us to ensure that the price doesn't move outside of minimum and maximum price of the base. A condition allowing us to ensure that recent price changes demonstrate higher lows is here. And then there are a few other conditions that I will not be capturing in depth on this video. But let's run it and see what happens. So we have 98 instances. I would actually encourage you to try changing parameters. I'm not claiming that the implementation that we have discussed so far is the most optimal. There are other ways of achieving more or less the same outcome. So definitely do play with the parameters and adjust this code to suit your needs. So we have some interesting candidates here, and yeah, let's say AI immediately catches my eye. So let's see how does that stock looked on February 28th. Okay, so we're opening a price chart of AI stock. And we can see that on February 28th, it has really exhibited all of the properties that we're looking for. The trading range is relatively narrow, and a series of high lows has been demonstrated as well. Unfortunately, obviously, it wouldn't have been a good trade. But in any case, I believe that there is a lot of value in looking for this pattern in the historical data. And again, please absolutely adapt the code to suit your needs. And you can implement new ideas of how to search for that pattern. Thank you for staying with me until here. I do hope that it was valuable for you and that you will be able to implement some of these learnings to start looking for volatility contraction pattern or other patterns on past stock data. In future videos, we will delve deeper into Minervini's approach and discuss ways to synergize volatility contraction pattern and other signals to increase probability of success. And finally, we will continue with our first back test. Until then, keep playing the numbers game.